Hello and welcome everyone. Today, we are going to discuss how to build a massive corpus without any unnecessary tension. You see, many people think wealth creation is only for the big shots, but that is not the case at all. By using smart capital strategies and doing the needful with your savings, anyone can become a wealth architect. We are talking about moving beyond just keeping money in a savings account or a simple FD. To truly multiply your wealth, you need a solid game plan that looks at the long-term horizon. Only then you can achieve true financial freedom for your family. Let us understand how to move from being a mere saver to a sophisticated investor in the Indian market context. It is high time we stop working for money and make our money work for us, no? Now, let's talk about the eighth wonder of the world, compounding. In our country, we often focus on the immediate return, but the real paisa vasool happens when you stay invested for decades. If you are starting a SIP of just 20,000 rupees a month and you get a 15% CAGR, do you know how much that becomes in 20 years? The math is simply mind-blowing. The key is to start early. If you prepone your investment journey by even 5 years, the difference in the final corpus is massive. Don't wait for the perfect time to enter the market. Time in the market is always more important than timing the market. This is the basic funda of wealth multiplication that every smart architect follows religiously. Traditionally, we Indians love our gold and zameen, isn't it? While these are good, a modern portfolio needs much more dumb. You need a proper mix of equity, debt, and maybe some international exposure to balance the risk. We call this asset allocation. If the Nifty is down, your debt portion provides the cushion. If inflation is rising, your equity portion helps you outpace it. Don't put all your eggs in one basket. That is just asking for trouble. By diversifying across different sectors like IT, pharma, and banking, you ensure that your portfolio stays healthy even when one sector is facing a bit of a rough patch. This is how you architect a bulletproof wealth strategy. Generating returns is one thing, but if you're giving away a huge chunk to the tax man, what's the use? A smart architect knows how to use Section 80C, 80B, and the nuances of long-term capital gains. By using ELSS funds instead of just traditional FDs, you not only save tax up to 1.5 lakh rupees, but also get the benefit of equity growth. And always remember the tax-efficient nature of debt mutual funds if held for more than 3 years. We must do the needful to ensure our post-tax returns are maximized. It's not just about how much you make, it's about how much you actually get to keep in your pocket at the end of the day, right? Why limit yourself only to the Indian market? While the India story is very strong, the world's biggest tech giants are sitting in the US. By investing in the NASDAQ or S&P 500, you get a hedge against the rupee depreciation. When the USD goes up, your investment value in rupees also increases automatically. Double benefit. Many platforms now allow you to invest in fractional shares, so you can own a piece of Apple or Google even with a small amount. This is what we call global diversification. It adds a layer of sophistication to your portfolio and ensures you are participating in global innovation, not just local trends. Please listen carefully. Before you start chasing 20% returns, you must secure your base. Without a proper term insurance and health insurance, your entire wealth plan can collapse like a house of cards if something goes wrong. And don't mix insurance with investment. Those endowment plans often give very poor returns. Buy a pure term plan with at least 1 crore cover. Also, keep an emergency fund equivalent to 6 months of your expenses in a liquid fund or a high-interest savings account. This is non-negotiable. Only when your risks are covered can you truly be an elite wealth architect. It gives you the peace of mind to stay invested during market crashes. The concept of retiring at 60 is slowly becoming old-fashioned. Many youngsters today are aiming for FIRE, financial independence, retire early. But for that, you need to account for the silent killer called inflation. If your monthly expenses are 50,000 today, after 20 years, with 6% inflation, you will need nearly 1.6 lakhs for the same lifestyle. Your retirement corpus needs to be big enough to generate an inflation-adjusted income for at least 30 years. We are looking at targets of 5 crore or even 10 crore, depending on your lifestyle. It sounds like a lot, but with the right equity-heavy approach in your early years, it is totally possible. So, what is the next step? Don't just watch this video and sit idle. The best time to start was yesterday. The second best time is today. Open that DMAT account. Start that SIP, even if it is just 5 or 10,000 rupees. Consistency is the key. Review your portfolio every 6 months, and don't get rattled by short-term market volatility. If you follow these smart capital strategies, you will surely see your wealth multiply over the years. I hope this session was helpful for you. If you have any doubts, please put them in the comments below. Let's all strive to become successful wealth architects for our families. All the best and happy investing.